Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 2nd of March 2026. Stocks are set for a horrible session and a horrible start to the week as US-Israel struck Iran and the conflict ignites. We've been expecting this for quite some time. It was probably a fair bit to do with what was going on in the US market on Friday. That military build-up was fairly unprecedented and pretty, we were pretty certain that something was going to happen over the course of the weekend. Nvidia and Apple there, a continuation of the sell-off in Nvidia as the AI concerns were largely still in the market. So obviously the Friday night session here at the moment, you can see on the heat map, was unaffected by the actual strike. It happened on Saturday. Trump does like to do these things on weekends for some reason. So it really was I think it was the worst month since March last year. And as you can see here, we had quite a few of these, the financial sector hit because we had a Market Financial Solutions, the UK mortgage firm, is showing stress in private credit. Creditors warned of a £930 million shortfall in collateral and allegedly a widespread double pledging where the same assets were used to secure multiple loans, which is just flat out fraud, leaving for an unaccounted for deficiency of more than 80% on the 1.2 billion in debts. So that really spread into the banking sector. Barclays have apparently got the most amount of exposure there with 600 million pounds, that is. So not US dollars, so a little bit more. They were down quite a bit. So that's where this is sort of spread. Obviously, the US-Israeli strikes on Iran have really just pushed that into the background, but that is something that we need to be very concerned about and we need to be very watchful of, because if credit spreads start to seize up and blow out, we will start to see credit freeze, and that is going to be a bigger hit to the economy than just about anything, to be honest. Saw Netflix bounce back as they withdrew their bid for Warner Brothers, and the Paramount surged on its preferred offer status as well. So Dell and Block both jumped on AI catalysts, which were mainly cutting staff. The move in Block was pretty significant. It was nearly half their staff. He's pretty much done it in one go and said that it would just be bleeding them out over the course of the next, few quarters would just be horrible for morale. So he's really just ripped the Band-Aid right off there. So it was up 20 or 30% on Friday here on the Aussie market. Wasn't too much selling here in these, in the SaaS sector overall. We're starting to see a little bit of stabilisation there. And obviously, Blind Freddy could have told you to be buying, oil into the weekend. That wasn't exactly, a genius move necessarily. We finished on a record monthly settlement for the ASX, and I would say, the gold and the precious metals part of the market will do very well today. The energy part of the market, which has been doing pretty horribly for nearly 2 years now, would do fairly well. And I'd be interested to see whether some of these critical minerals start to play out as, locking down supply chains, just the same as what oil does overall. So that would be a new sort of style move if the critical minerals started to go a little bit better bid as people try to lock down those supply chains for those battery minerals, etc. But it'd be something that, logically should maybe start to happen given what's been happening over the last sort of 12 months or so. So things like rare earths, things like lithium, things like anything really in that critical mineral supply, copper particularly as well, which normally will get hit on this sort of thing. But I would go as far as to say you might even see some of those go bid. As you can see, Nasdaq is now in the daily sells. The daily only just a daily buy. We've got a daily sell in the S&P 500 as well. So the technicals really starting to turn on that US market overall. And we've got, not the greatest start to a week really overall, leading into Monday. But, Aussie's still going relatively well. That banking sector will be of concern today, I would imagine. And we'll just see how things pan out there. Gold and silver, we're up. We've got silver back at $94. But silver sometimes does not respond very well to geopolitical. The gold-silver ratio can tend to blow out a little bit in gold's favour, and silver, being a bit of a risk-on asset, can actually sometimes come off. But platinum was up 4% after being up a little bit more early on in the session. Crude, I would imagine, will rally further over the course of the day. Obviously, we don't have any prices until we get into 10 o'clock. So I just wanted to get on top of this in the morning now, beforehand for everyone. But silver obviously had a very good week, as did gold. We expect gold to continue higher. There could be some bid tones in those fringe precious metals and copper, just on the supply chain issue. But the normal traditional move is for them to be they're considered risk on assets, and they will get a little bit hit because people will start to clamour for the US dollar overall. So if you go to the written part of the report, look, we've got the background here. The mass protests, the Trump State of the Union, the largest military build-up. Day one, Trump announced the strikes, and then basically I think they had the Ayatollah within a couple of hours overall. And there's been a couple of, the major things. There's 3 US servicemen killed. There was over 150 people killed at a school in Iran. Not good, obviously. 9 Iranian ships were sunk in the Hormuz Strait, or the Strait of Hormuz, and then 6 killed in Israel. And then, according to Trump, 500 objectives have been struck. So that is as of sort of this morning, and is ongoing. So, your winners and losers here. Obviously, your near-term winners are going to be oil and energy, defence and aerospace, frontline, the higher spot freights and insurance rates, will maybe flow through, and obviously safe havens like gold, miners, gold-linked ETFs. The likely losers are going to be airliners, cruises, so tourists, as airspace closures and cancellations cause effects. Shipping and ports will probably be fairly affected as well. UAE exposed assets, given there's been a few strikes there, and then broader cyclical assets overall. So we'll see. There's been a bit of flip-flopping about who would be, whether there'd be talks, whether there won't be talks, whether Trump said that this could go on for, could go on for 4 weeks, and then he said that they could also have talks. He's been holding press conferences without the press at Mar-a-Lago. So we'll have to kind of pull together a bit of, a little bit of a broader thing over the course of the day. So the reported explosions are, the beige there. US and Israeli strikes have been in the yellows there. Iran and proxy responses have been in these areas here. And then Saudi Arabia said it's intercepted missiles. I think the UAE's been hit, and there's been reported Israeli hits, but there's been nothing really, in terms of major damage done overall. And it really does bring our key catalyst monitor. So we've still got these blue hour concerns in credit. There's British private credit concerns as well. This anthropic agentic AI threat to the software sector broadly. The AI trade really running out of steam, just from a technical standpoint with Nvidia, etc. I mean, just bearing in mind that Nvidia is trading at a forward PE of around about 14 at the moment, which makes it cheaper than just about most stocks on the planet. So this could be a really good buying opportunity. And then obviously geopolitical, the military strikes in Iran, and Trump saying it could be up to 4 weeks. Trump tariffs is still a key catalyst we need to be monitoring as well. And then signs of stagflation. So Friday night as well, we had PPI come out and it was stronger than expected. I think we had headline PPI rising 0.5 and then 2.9 year on year. Core rose to 0.8 and month on month and 3.6 year on year, all well above consensus, which is stagflationary. Signs, because we've got the US economy slightly weakening as well. So really, this list here is not good for equities overall. And what's been holding this market up for the course of the last probably 2 years has been AI. And it's not doing that at the moment. It's actually adding to the downside. So, we've been fairly risk off. We've got a software strategy that we're pausing for at least a couple of days now, which we'll keep an eye on. But I wouldn't be surprised if this starts to snowball a touch, because there really is no positivity in any sector here at the moment that's going to necessarily save this as it stands. And the main points here, obviously, Barclays, Apollo, Wells Fargo, these are some of the biggest, in these biggest private credit funds. Barclays reported to have 600 million quid of that 930 million quid. Atlas, which, again, one of the bigger ones. And we're just, so this is, again, just worth monitoring. So go and have a look at that software survivors. It is a 12-month strategy, so you'll obviously be getting better entry prices here as it stands at the moment. As we sort of delay the entry on that, we were looking at striking today, but we will strike later on. Either way, it's very good to go and have a watch of that to get your head around that, the software and which software companies will have that moat. And and see that investment thesis. Kai Chen does an extraordinary job explaining all that. So you can just scan that QR code, and if you want to get all this just delivered to you, to the palm of your hand via the Mosaic, Mosaic app, just scan the QR code here. Less than a coffee a month, coffee a day, around about the $150 a month mark. 4 recommendation services, but up to the minute updates on what you should be doing with your portfolio. Given what we've done, what markets have done for the last 3 or 4 years has been pretty linear and in the same, or roughly of the same ilk. It's been very growth heavy, and as we see the market switch back to more value and away from growth, maybe you want to be a little bit more mindful of where your portfolio sits, because what's happened and what's worked over the last 3 or 4 years is not necessarily going to work over the next 12 to 24 months. So I would highly recommend having a look. You'll get your first month free. Don't have to pay anything. You can cancel whenever you want. And you'll get these immediate updates straight away, as well as our podcasts. And we had a bunch of earnings results and things as well that were very timely, well worth the $5 a day. So, be careful out there today, people. Make sure if you want to have a portfolio review, you can obviously get us on our through the normal channels, and we can have a bit of a look for you. I will speak to you again tomorrow. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.